Well, welcome everybody. Today we are going to be talking about blockchain and the decentralization of finance. This is an intermediate level session, so there's some working knowledge of blockchain and distributed technologies that's assumed, but we're still going to lay the groundwork a little early on and then really get into how some of these technologies are disrupting finance and markets. So we have a great panel with us today. Starting from the far end, we've got Paul VERADITTAKIT, who is a partner at Pantera Capital, which is an institutional investor managing about $1 billion of capital focused on blockchain and cryptocurrency. Paul has focused his time on both venture capital and initial coin offerings. Next to Paul, we have Emma Channing, who is a co-founder of the Sxsw Group, which is an initial coin offering advisory firm that specializes in security tokens. Emma is, like me, for better or for worse, a lawyer, and was previously in private practice at HSF, Skadden, Simpson Thacher before moving into this exciting space. And then immediately next to me, I have Nick CHIRLS, who's a general partner at Notation, which is a first check venture firm based in Brooklyn, New York. He was previously head of seed investing at BetaWorks, a startup studio that incubated companies like Bitly, Chartbeat, Dots, Giphy, TweetDeck, and many others. He's been an active investor and builder in the blockchain community since 2013. And Notation is an active investor in blockchain companies and crypto assets directly through their funds. And finally, me, I'm Dan KAHAN. I'm a business lawyer at Morrison & Foerster, or MoFo, which is about a 1,000-lawyer law firm with 16 offices globally. I focus on working with emerging companies and venture capital investors, increasingly in this space, but also with companies in enterprise and cybersecurity. I'm a member of MoFo's blockchain and smart contracts practice, also of the Wall Street Blockchain Alliance, and the Enterprise Ethereum Alliance Legal Industry Working Group. So as I said, it's an intermediate session, and I'm going to kick it off with a really easy question, softball question for Nick, which is, what is blockchain in 60 seconds?
Yeah. So we were talking about this actually backstage. We were talking about how this was going to be the most difficult question of the day. Because the reality is that, blockchain means many different things to many different people. For some, it's a religion. For some, it's a new financial system. For some, it's a new way of building projects and coordinating work. So it means a lot of different things. I think from a technology perspective, we're technologists at Notation and invest in technology projects. So from a technology perspective, the way that we think about it is it's a new kind of database that has some interesting new properties. So it's a database where a distributed group of people can verify transactions and data in a way that doesn't necessarily require a centralized third party and doesn't necessarily require them to trust one another. And that data sits on the blockchain and lives there permanently, publicly, at least until today. So that's how we think about it. We think about it as a new kind of database that has different attributes to other databases historically, both good and also challenging attributes as well.
That is a great 60-second explanation that I'm going to steal next time I have to do it.
All right. So I think it's a religion, though. No, I'm kidding.
And then, so turning to Paul, what's the connection between blockchain as a technology and cryptocurrencies or tokens that we've been hearing so much about?
Yeah, that's a great question. So, in the same line as Nick, we think of the blockchain as basically a decentralized, immutable, transparent ledger that enables the peer-to-peer transaction of any value or tokenized digital asset. Now, there's two types of tokens that are starting to emerge. There's the utility token, which is a token that's needed to use a certain technology or product. And then there's also a security token that more resembles equity into a company or profits into a company. So I guess one easy example to kind of illustrate that would be going to an amusement park. And going to an amusement park, you buy tickets so that you can access rides. So that would be a utility token where you need these tickets to go on these rides. Now, if you went to an amusement park and you purchased a security token, that'd be more like owning a portion of the amusement park. And when the amusement park made profits, you got a certain percentage of those profits. So those are two types of tokens that we're encountering. And for instance, Bitcoin, if you wanted to be able to use the properties of the Bitcoin blockchain, you'd need to buy Bitcoin and then be able to send that value to somebody else. So you need Bitcoin to be able to actually use that blockchain or to be able to record things on the Bitcoin blockchain. So we consider that a utility token. Now, what's going on right now is there are a lot of new products and technologies that are fundraising using tokens. These tokens are essential to use the product or technology. And now what is happening is, for these entrepreneurs, they're able to raise capital from, accredited investors, maybe sometimes non-accredited investors all around the world, and be able to accelerate a network effect. And the way that these projects look are not, necessarily typical of what venture capitalists invest into. So a lot of these projects are open source. Teams are distributed all around the world. So, this enables these sorts of projects to be able to raise capital, be able to accelerate a network effect, have people invest and be part of the project, and then, this gives them a way to basically acquire users and gain market share at a much, easier rate than going through traditional venture capital and spending dollars. So what this really enables is, we think, the democratization of fundraising going forward.
Thanks. And one of the interesting things is Nick, just circling back to one of the things you said, it's a distributed database. And I think, Paul's answer kind of helps answer a bit the next question, which is, there are a lot of distributed database technologies that have come out over the past 25, 30, 40, 50 years. And you don't read about them on the front page of the Wall Street Journal every day, much to the chagrin of database engineers. So what is it about blockchain that is so exciting to people in finance, to financial institutions, to developers? I know there's the virality and the network effects, but what else about the technology is really exciting to people in the ecosystem?
The way I think about it is, when you think about blockchain as a database, it's actually a pretty poorly performing database for most things. It's a pretty bad database in many ways. And some of those ways are, at least today, not particularly scalable, very low throughput of transactions. If you compare the Bitcoin network to the Visa network, it's like a very slow, poor performing system. So I think the way that we think about it is the projects that we think are interesting are, where might a distributed database without a centralized third party have value and be comparatively performant compared to a centralized database. So Paul mentioned Bitcoin. I think Bitcoin's primary use case is as a store of value, particularly for folks that have tight capital controls in countries where they don't necessarily trust their government's fiat. That's a pretty interesting use case for Bitcoin, and because there's no centralized third party that's controlling the transactions, well, that's actually a pretty interesting use case for a decentralized, distributed database. And even though it's slower than the Visa network, no one can actually stop your transaction, or it's very difficult. So the way that we think about it is, you want to think about areas where distributed trust, even if it's a worse performing database in some ways to its centralized counterparts, actually makes sense. And the reality is that today there are actually very few use cases in areas where it actually does.
So that's interesting, and that kind of gets to the censorship resistance point, part of that, which I think a lot of people in the community think of as a big feature of various blockchain technologies and projects. Turning to Emma, I think there are probably also institutions, including regulatory institutions, that might think that censorship resistance is actually a bug, not a feature. And so, what are you seeing? I mean, you've been in the sort of the middle of this business for a while as it's grown, and what have you seen in terms of the direction of regulatory initiatives in this space, in terms of level of intensity, level of focus, level of attention paid?
Well, we're seeing a very wide approach globally. The European Commission has just come out with a number of large sandboxes, and they are being very liberal. They're making a clear distinction between what they think are utility tokens and what they think are actually securities. The analysis from a civil law jurisdiction, sort of the Germany, France, Switzerland, and that drives a lot of the Commission's views. It's simpler for them. It has to have an income stream to be a security within European law. BaFin is doing an extraordinary job there, the German regulator. You can email into them. It's a web form you complete, or you can phone them, or you can write it on a letter and literally mail it in, and they will get back to you in 2 weeks for 90% of the projects who go in. And they'll either go, we think you're good, or we think you're getting close to the supervisory laws, go find a lawyer. And you know, the one thing that I think both you and I would say is, in any case, if you're even thinking about doing this, go find a lawyer. We often come across someone who, we turn away about 95% of the people who approach us, and we're increasingly coming across people who just pull down the SAFT off Cooley's page and have used that and have raised under that without any legal counsel at all. And that's not going to go very well. The US is taking a fairly different approach this spring. They're very much of the view we had in the 21A DAO report last summer, very much of facts and circumstances analysis on a test that we call HOWI, which has 4 limbs to it, and it's whether you have an investment of value in a common enterprise in the expectation of profit without from the efforts of others, from the efforts of management. The SEC at the moment is very much, there is no such thing as a utility token. All tokens are securities. And that's the approach that they're taking. And we're seeing a lot of emphasis on the exchanges. There was a recent announcement by the SEC on the exchanges, hitting some very good points. In particular, the question of whether all users of exchanges have equal access. And I think, you know, we're going to see an interesting time in the US between the 4 or 5 regulatory agencies, specifically the IRS, Treasury, the SEC, the CFTC, and FinCEN.
And the state regulators.
Yeah.
And we're in Texas now, and the Texas state securities regulators have been very active in policing fraud and other projects that they feel violate state law, even beyond the sort of federal regulatory regimes that you mentioned.
Yeah, I mean, obviously the interesting one is Wyoming, that's attempting to make a stand for utility tokens. So it's going to be an interesting year seeing how all of this plays out.
So Paul introduced this concept earlier, and for those who aren't as well versed in the area, we refer often to things like cryptocurrencies, security tokens, utility tokens. On the latter 2 items, I mean, just from sort of a legalistic perspective, Paul kind of laid out some of the economics that are a little bit different, but from a legal perspective, and not asking for an opinion, and nothing in this panel should be considered legal advice. That is the most important point for me and Emma to make out of this whole thing. But just generally, what are some of like the features you would see in a utility token versus a security token, if there even is such a thing as utility token?
We would argue there is such a thing as a utility token. Generally speaking, you're looking for something that is inherent to the blockchain technology that's in the heart of the project. That token provides a function. On one, it can be one level, it can be discounts, it can be a form of payment, but that token has a clear function within that platform. There is a diversity of views, particularly from global regulators, about whether the platform has to be completely built at the time that the ICO raises to be considered a utility token. So FINMA, the Swiss guidance, regulators just come out with guidance that has basically specified that to be a utility token within Swiss law, your platform has to be fully functional at the time the ICO launches. BaFin, on the other hand, and the European Commission aren't taking that approach. So yeah, that's generally speaking a utility token, and we do believe that if you truly have a utility token and it's right at the heart of blockchain technology within your project, if we turn that into a security, there's a lot of questions about why don't you just register? Well, registering on an S1 involves about $1 million in fees and about 12 months process. It's a 300-page document, there or thereabouts. So there's no kind of just register, at least in the US. There are exemptions from registration, particularly Regulation A+, which is very interesting, and Regulation D, and when we run security tokens, that's generally what we run on. But if I did that to a true utility token, I'm going to gut its function because its ability to be freely transferred within the system vanishes with the restrictions of the securities laws. So we do think there is a place for utility tokens, and we hope to see a window open in the US. Otherwise, I think we will see a real trend towards Europe, particularly with the position that the European Commission and Germany is taking.
So talking about utility tokens for a minute and just kind of broadly defining them as a token that has a sort of a non-incidental, non-investment purpose. So for Nick and Paul, one of the things that we're seeing a lot is there are both completely new projects that are popping up, many open source, some not, but there also are a lot of larger companies, maybe venture-backed, maybe even bigger than that are exploring doing tokens to either build a new service kind of within their ecosystem or do something new. What are you guys seeing in that regard, and what in those two dynamics, like something totally new versus a company that already has a product or a service that's building sort of blockchain on top of it? Like, how do you think about evaluating those types of projects?
Yeah, so I think for us, we're open to investing into new projects or existing projects. I think the bar is still the same. It's looking at teams. It's looking at the problem that the company is trying to solve, and the use of the token, and really, is this token going to enable this company to open up a new market or be able to gain market share in an existing market? Now, I would say that we have been investing more into new projects because a lot of the existing projects that are launching token sales have just been sort of bolting on a token without really a need for a token. And for us, we really dive deep into why the token is being used. Does it prevent fraud within the system? Does it help governance within the ecosystem? Is it used to enhance the product? Is it used for cross-border payments, et cetera? So for us, it's really about the utility of the token and really understanding how that fits in within a certain technology.
Yeah, I mean, so Notation is a firm based in New York that invests in very early stage tech-heavy companies. So they tend to be somewhere between an idea and an early prototype. And my partner and I have been investing in the New York community for the past decade or so. So we think about many early stage blockchain projects in very similar ways to we do traditional startups in analyzing them. So we think a lot about the founding team and their insight and their passion for the project and their technical ability to actually get a real product to market, not just raise an ICO, but actually get a working project to market that will service users. We think a lot about the market opportunity, and like Paul said, we think a lot about is the blockchain technology actually critical to this project? We're seeing, as I'm sure everybody is, a lot of projects that attach blockchain to the project name, and when you really think about it and ask the question, is this actually critical to the project, 90-something% of the time it's not the case. Like, not to pick on Paul's example of the amusement park, but do you really not trust the amusement park that you go to honor the ticket that you just bought? Like, how often does that actually happen? Never. So, so the reality is, like, the way that we think about a native blockchain project and a token is the token actually critical to this project? Is it enabling a decentralized, trustless community that can now work and operate or mine token or secure the network in new ways without necessarily knowing one another or trusting one another? And so if you apply that framework to most traditional companies, whether that's big companies now that are doing blockchain projects or startups that are thinking about how to pivot to blockchain, the reality is it really doesn't make sense for the large bulk of companies and projects today. So we think about it, very similar to early stage startups, but we apply this new filter, which is, is the blockchain technology and token actually native to this project and needed? Could this project not exist without it?
So in terms of backing projects, there are a number of ways that any one of us can go and try to measure the success of a particular token by looking, for example, at the value on an exchange or the number in circulation or the number of different holders. But as investors, how do you think about, aside from just token value, I mean, you're backing like protocols also and companies that are in the space. How do you think about when a project has actually achieved success?
So, the reality is where blockchain is today is there's very, very little actual usage of any of this stuff. Like, this is really, really early days for this new type of technology. I think there are some real use cases for Bitcoin and Ethereum and some of the projects that I'm sure most of you have heard of, but the reality is for the long tail of blockchain projects, there's very little actual usage. And so the way that I think about long-term success of the projects that we back, and we are long-term believers in the space, and when we invest in a blockchain project, we intend to be investors in that project for a very long period of time. My long-term measure of success is this actually providing real value to end users? And that might be, it makes work more efficient in some way, or cheaper, or a collection of people can do new things together in ways that they hadn't before. But ultimately, this stuff needs to be usable for it to have value. And other than a few very small pockets of the market, the reality is most of it isn't being used today. So I hope that in the years to come, there are many more examples of these projects becoming useful. And I think we're heading there, but it's still early days.
Yeah, I mean, we would usually, well, we do a lot of market data. You can sign up on our website for our market research. We would define as successful chain deployment in the case of protocol, or the product or platform actually being launched with users on it. And a regular update to the GitHub repository and a regular ongoing rollout of technology. That, unfortunately, looking at last year's ICOs, is around 4% for projects with market caps above 50 million and 2% for projects with market caps between 50 and 100 million.
So what does that percentage represent again?
Those are what we would consider successful, basically in the same way that Paul described. But the protocol was was deployed, and/or the platform is up and running and has users on it. And this is a tiny, tiny percentage of all ICOs. Conservatively, 80% of ICOs last year could be considered scams, and they just didn't get off the ground because either they got hit by regulators or the entire market just turned away from them and they didn't raise at all. And this noise and chatter is the one thing that we do hope the current regulatory activity is going to damp down, because we do think that tokens are a huge evolution in terms of how companies raise and what they have access to, and the Jobs Act liberalizations have not really been used, particularly Regulation A+. And so we have companies stalling and finding it very difficult and very expensive to raise around BC Series. And we think tokens are, and the peculiar liquidity and aspects to them, have a real power to change how innovators and makers raise, as Paul's described. So we do think the end result is very important, but we're not under any illusions about the volume of scams that are out there.
Yeah, I mean, I think both of the panelists are correct. I mean, it's really early right now. I'd say it's the first half inning of a baseball game. And what you guys have to really understand is there's a lot of cool applications that are being worked on, but at the end of the day, the infrastructure isn't quite there yet. We're using a 56K modem right now, and you have to understand that it's going to take time to build that infrastructure so that it can handle some of the cool applications that are being built simultaneously. And I think for me, when we actually start using products, just like Nick said, I mean, that's whether that's direct to consumer or whether we're using a product that we don't even know that the blockchain is being used in the background, but it's, again, providing features of, faster, cheaper, more transparent, or, it's just providing, a lot of services that we couldn't get before in a centralized system. And it's going to take time. I mean, for instance, my colleague Joey Krug, who is one of the founders of Augur, they did one of the most successful ICOs 3 years ago on Ethereum, and that was only $5 million, and that was a huge success. And now it pales into comparison of some of the ICOs that we're looking at right now, but they still haven't even launched yet. It's been 3 years. And part of that is when you're launching a network that needs to support a global community and a ton of money, you have to be very methodical in terms of making sure that it's secure, making sure that everything is audited, and making sure that you have the right components in place to be able to support such a large launch. So, supposedly it's going to launch sometime this year, and that may be a first test of really can an application like that gain adoption with users, and will Ethereum be able to support everything that goes on with that application. So once we start seeing some of these applications come out and people can actually really put real money through it, then I think that'll be a good test of the progress that the ecosystem has made.
So there's some startup incubators out there that have had public requests for product that have been popular over the years. And so one of the things that I'd ask Paul and Nick is whether, There are a lot of technologists here, and you have a pretty big platform talking about this now. So are there any either protocol level things or just products on the blockchain that you would really like to see somebody build that you'd be excited to talk to them if they came to you and said, hey, this is what I'm working on?
We're putting all our eggs in the amusement park. No. Yeah, scalability is obviously a major item for blockchain from a technology perspective this year. And we're seeing lots of different approaches to that. There's many different approaches to Lightning networks, which enable folks to do some of the transactions off-chain and not directly on the blockchain. And there's different approaches to how to do off-chain scalability. There's a movement to proof of stake from proof of work, which is another big item on the Ethereum roadmap and some other big projects around scalability. So we're most excited about infrastructure layer stuff that will make ultimately the applications built on top of it more usable. So anything in those categories we're really excited about and would love to meet folks building solutions there. And then I also really think there are certain areas that enable new types of coordinated work that I think are really interesting. So areas where people across a community or the globe can contribute to a project, and that's either from a computing perspective or from a data perspective or other ways. They can contribute in a way where they don't necessarily need to know each other or trust one another. And so, that could be everything from like next-gen Google Maps to next-gen Uber to all sorts of products where you could imagine there's no centralized profit-seeking entity and a very coordinated effort from a global community. So things that coordinate work, whether that's computing or data or something else, we're excited about as well.
Paul?
There's a token that has Ryan Gosling as a developer. I think that's something I really want to buy into. Yeah. But aside from that,
50 cents buying.
And that one too. I agree with Nick. Like I mentioned before, we're on a 56K modem, so we need to find scalability solutions. And we've also invested already in a couple of ICOs where there is coordination of work, coordination of resources, coordination of data, contribution of data. So now that you're able to have a token and be able to get people to contribute work or data and have that be on a blockchain, encrypted, and be sort of accessible for really cool applications, applications that can use machine learning to solve new problems because there is this aggregation of data, has been one of our theses and has been pretty compelling. I'll also talk about security tokens. I think that a lot of people haven't gone that route yet, but I think it can be very big. I think with the uncertainty around utility tokens and some of the impact that may come from issuing those type of tokens, issuing tokens that represent equity or profits, if you do so in a compliant way, I think can be very large. For instance, being able to use the transparency and the trustless of the features of the blockchain to be able to maybe participate in a real estate property, fractional real estate ownership. I think that opens the door for a lot of millennials to invest into real estate. This could be a new asset class for them. And having that orchestrated on the blockchain where you can record ownership of each of these fractional pieces of real estate and be able to have liquidity around real estate, I think is really exciting. Or maybe even a regulated DAO, that could be pretty cool too. Be able to actually get a group of people to source deals be able to coordinate in terms of choosing companies to invest into, and then be able to automatically get their portion of profits. So I think there's a lot of potential in security tokens. It may take a little bit of time because there's the problem of liquidity, which exchanges are actually licensed to be able to support and exchange security tokens, and also KYC and AML to make sure that they do stay within accredited investors.
So I'm really happy that you mentioned the market access point, because one of the themes of this panel is to talk about how blockchain can disrupt financial services, and there's a lot of discussion in the media about blockchain disrupting banking, disrupting potentially investment options. You talked about Bitcoin and some tokens as a store of value, but I want to think about financial services a little bit more broadly, and a topic that's probably going to hit home a little bit more for Nick and Paul. And so when you have tokens that are potentially purchasable by anybody, and a much more democratized market for a lot of these investing at the protocol level, for example, can't anybody be a venture capitalist, or is there still a role for specialized managers? And what's that role? How is it different from investing in traditional venture?
Well, I guess I'm the most traditional of the investors up here, in that my firm does have what you consider traditional venture capital funds, and we're not planning to change that anytime soon. We're not. I think there's some VCs that are thinking about new models around crypto, and there's obviously tons of folks raising dedicated crypto funds. There's folks that are talking about raising tokenized funds. So there's definitely significant interest from the traditional venture community to access this stuff. I think there are a number of traditional VCs that are investing in crypto assets through their funds, and we can do that up to a certain amount based on regulatory requirements. So it still crypto assets represent a relatively small amount of our funds. But there's other very well-known firms, Andreessen and USV and others that are doing it through their core funds. So I don't think the traditional venture business is gonna. I don't think there's plans within the traditional venture business to totally change our model and convert into crypto funds. And I think the reality is that folks have been talking about the disruption of the venture business for many years now, and that is through things like AngelList and the Jobs Act and crypto. And I think the reality is that from my perspective, I don't think that there should be special access to these opportunities for accredited investors versus non-accredited investors versus VCs versus non-VCs. From a philosophical standpoint, I believe that everyone should have access to these opportunities. But from a services standpoint, we provide a bundle of services. We provide capital, we provide advice, we provide help around go-to-market and customer acquisition and building a product. We were founders ourselves, so we bundle that service. And for the foreseeable future, we will continue to work with early-stage founders, whether that be blockchain founders or traditional startups, that value that bundle of services, and will raise from traditional venture before they raise, in an ICO or tokenized product. There very well may be some portion of the community and blockchain community and founders that say, hey, you know what? I don't actually value that service, whether that's from Notation or Andreessen or whoever else, and I just want the cheapest capital available, and that actually might be the case, in whether it's through an ICO or elsewhere from the community. Now, you have to then manage that community. There's a reason that people wait to go public for a long time. You are managing a large community of shareholders and reporting to them. So I think there are advantages to staying private and choosing the traditional venture capital bundle over an ICO, but certainly there's folks that will choose to go straight to ICO, and that's totally fine. And we're making sure that we can participate regardless of what founders choose to do.
So if you think of your customer as the founder on the venture side, that makes sense. And then I guess the question for Paul is, if you're thinking of your customer as your limited partners or your fund investors, one question that I've certainly heard people ask is, well, if I can go buy these assets directly, why do I need a crypto fund?
Yeah.
So what role is there for asset managers in a world where, again, access to the underlying assets is maybe a bit more democratized?
Yeah, no, that's a great question. So, we don't believe that venture capital and equity is going away. So we are a specialized fund in that we look at blockchain and companies and cryptocurrencies, but we do have both a VC fund and an ICO fund. So, we can deploy using either strategy, and we actually think that there's a lot of exciting opportunities on the equity and the VC side. And of course, what comes with those investments come with the partners involved with our firm and providing the value add and the strategy, the relationships, the governance. On the ICO side, I think we probably see 200 ICOs maybe coming in through our inbox, like a month at least.
A month?
Yeah, at
Okay.
least. I mean, so there's a lot of noise out there, and as a retail investor, to be able to filter out through that noise and be able to select the right ICOs that are going to be successful, it's going to be very tough. And not only is the volume large, but also the technologies are new, and the people are all around the world, and it's tough to be able to do reference checks and vet who these people are. They're going to be good stewards of your capital, et cetera. So, the value of going with a VC fund or a ICO fund like ours would be that we have access to some of the top entrepreneurs and projects out there. Some of them come through that inbound trail, but a lot of them comes through our network, and our network of great LPs, our network of great VC funds like Notation Capital and Nick, where we can see the deals, we can do the appropriate due diligence on the tech side. A lot of these founders that are doing initial coin offerings, they are current entrepreneurs within the space, or we have a relationship with them through our network. So some of the teams are already pre-vetted, and then it's just diving into looking at the market and the token economics and the token usage, et cetera. So it's tough as a retail investor, but if you are going to do it, I would suggest starting off by maybe investing into one or two coins or one or two indexes, or just picking a space that you're particularly familiar with and really excited about, and investing what you are fine with losing, expecting it to go to zero, but at least you get to see the process in action, have some skin in the game, learn about an exciting space, and see what happens.
So this is a general interest conference, technology conference, and not a blockchain conference. I'm going to ask two questions that they would never actually ask at any blockchain conference I've been to. And the first one is for Paul, which is, does it ever worry you how much talent is actually moving into the space?
It's exciting. I talked to some of the top venture firms out there that have been around for decades, and they have the access to their network of portfolio CEOs and portfolio CTOs, and they're all telling me that the best talent in their pools are all building companies on blockchain. That's exciting for me to hear, because at the end of the day, we need entrepreneurs to start companies and have innovative ideas, but really right now, you're seeing all this capital being raised, what, 6 billion last year, 2 billion already in the first 2 months, that we're gonna need people to build these companies and build these products. So we need more engineers. And if we're starting to see the best talent go to building these companies, then that's exactly what's needed for this ecosystem. It's more talent, it's more education, it's more schools, and I think it's going to be a cycle where once we start having some products out there and people can actually use things, then it's going to propagate more education to other people to get into this space, and then we'll have more talent building more products.
Same for you, Nick.
Yeah, I think by far, I mean, I totally echo that sentiment. I think by far the most exciting part of the space today is just how many talented technical people are going to build in it. Not just start projects, but join high-profile projects. And so, our job at Notation as early-stage VCs is fundamentally to go where the smartest technologists are building the most interesting things. And this is undoubtedly an area where we're seeing that. And it's not just in New York where we are, but it's in California, and it's in Berlin, and London, and China, and Argentina. And so I think it's very, very exciting to see so many talented technical minds go and solve some of these very interesting, challenging technical problems, and do that globally across the world. So I think that is by far the most encouraging part around the space today, much more so than the capital coming in, or the ICOs, or the regulatory stuff. I think it's very encouraging for the space long term.
And I think, just a comment is you do notice, has it been your experience that you notice also a lot more decentralized teams in this space? It's almost sort of that you see the structures of these projects kind of as a manifestation of the sort of underlying philosophy. Are you seeing that also?
Yeah, it's very common to see many of the most high-profile blockchain projects. Almost all of them are essentially distributed open source technology projects. And so, like for us specifically, we tend to invest quite locally, but it's very difficult to apply those same filters to blockchain because it is everywhere, it's global. Silicon Valley doesn't own this ecosystem like they do a lot of other areas of technology, which is, I think, very exciting. And yeah, many of these teams are distributed, across the country and the globe, and they're working together on what are fundamentally open source technology projects.
Emma, are you seeing? I know you work with a lot of different projects. Are you seeing the same thing? A lot of distributed teams.
Again, we very much believe in the future of venture capital. We very much believe that if you are early stage, if you guys do not have revenue and profit, if you're still at an MVP level, then your best bet is Series C, Series A from VCs, and that support and governance and everything a VC brings. Again, we're looking at, of those that actually raise, half are failing. And while that's not necessarily out of the park for startups, there is a question about whether those projects that are raised in the first place. But yeah, we tend to work with established companies who are looking to do an ICO for specific reasons and have a specific aim in mind.
So we're going to go through some of the questions that we're getting in from our attendees. And the first one I'd put to the panel, which is, without giving any investment advice, but what are some examples of existing viable applications? And I will go and throw one out, which is everybody loves CryptoKitties. That is a viable application. And what are some other examples of things that are actually in the wild today that people are using?
Yeah, that's it.
That's it.
Yeah, so through our venture capital fund, our thesis has been it's so early right now, and we want to be investing into infrastructure. On infrastructure on the token side, it means, hey, more scalable blockchains, but then also we consider infrastructure as, the tools, the picks and shovels that are needed for, some of these cool applications to emerge. And one of the applications that we think that's going to be huge using cryptocurrencies is cross-border payments. For that to emerge, we're going to need people in different geographies to be able to buy and sell and speculate on cryptocurrencies. So we've invested into a bunch of different companies located in geographies where, maybe it makes sense for cryptocurrencies to be a store of value, or there's certain attributes, inflation, capital controls, remittance corridors, high propensity to adopt, virtual currencies. Maybe there's a, huge, online gaming community in some of these places, or there's a huge mobile penetration, and they would be open to, mobile banking, digital currencies. So we've made these strategic bets, almost thinking of them as routers for money. So instead of VoIP, we think that cryptocurrencies enabled MOIP, money over IP. And after investing into a lot of these different routers for money, we are now seeing companies that are focusing on using those routers to move money across border using cryptocurrencies, where fiat would move from a local bank to the company's bank account, and they would basically do the FX over Bitcoin or Ether or Stellar, and it would go directly into the receiver's fiat currency. And it's not talked about quite a bit, but we're seeing hundreds of millions of dollars being transacted across borders using cryptocurrencies. And we think that I think eventually we may see a world where, we all have cryptocurrencies and we're all sending it across borders, but in the meantime, it's these companies that are just providing a service using this money whale, where the end user just doesn't need to know anything about cryptocurrencies. So we think that that's a use case right now that could end up being one of the first killer use cases of blockchain technology.
So picking up on another audience question, where can blockchain be useful? What segments of finance will be the growth segments? You just mentioned cross-border payments. But what about things like micropayments? That was something everyone was talking about. You talked, Nick or Paul, a little bit about what micropayments are and whether that's still something that seems like a viable use case for blockchain. Anybody?
Yeah, Paul might know better than me, but that was actually one of the original, even if you go back to the original white paper, that was one of the things that was, continually referenced, was the ability for blockchain to be a global payments rail, specifically for very small transactions. And the reality is that today the transaction costs associated with sending Bitcoin, for example, there's many different blockchains, but Bitcoin specifically, it is actually quite, it's a non-trivial amount of fees to transfer Bitcoin to another person. So the micropayment, I don't think Bitcoin is particularly well suited for a micropayments network. Now there are, we've talked about lots of the scalability solutions and ideas that are coming in 2018. One of them is a Lightning network, which is essentially a way to make payments off-chain, and then, there's a few different implementations, but one would, where then you then batch a huge group of payments back onto the blockchain, that in theory could make micropayments a reality. But a lot of that will likely have to happen off-chain.
Yeah, no, that's a great description. of the infrastructure that's needed. And in terms of use cases, there's a couple of use cases that we've invested into. One around micro tasks, so be able to almost, Mechanical Turk type of tasks, where people in third world countries can perform tasks and get small amounts of payments, or in this case, cryptocurrency. Again, being able to transact small amounts of money is not possible right now using the traditional rails because, there's a minimum of a 27 cents, threshold for transactions. So be able to transact on a very micro level for certain tasks that you do and have that be instantaneous across borders, that's been one use case that we've been pretty excited about. Another use case is around content monetization. So, the Wall Street Journal charges this subscription fee, and we end up, sharing the same Wall Street Journal account, or we just, don't even use it. Well, what if you can get paid for watching a video or reading, sort of a certain, content online, and do so in a very small amount of capital. So we think that really opens up a new type of business model that is enabled by cryptocurrencies.
So probably our final question from the audience. Everyone talks about the positive implications of blockchain technology. Are there any negative implications that you can think of relative to the pre-blockchain status quo? So I'll throw out the energy usage, problem, which is the elephant in the room. And Nick, you talked a little bit about proof of stake and efforts to mitigate it, but just talk a little bit about like the energy usage issue, which some people flag as a good thing or a bad thing. Do you have?
Yeah, I mean, blockchain the blockchain network uses an incredible amount of compute and energy to verify the transactions on the blockchain, and that is not a particularly good use of huge amounts of energy. So, so that's an obvious one. I think governance around blockchain is still very much TBD, and a very interesting area of different blockchain projects, whether that's Bitcoin or Ethereum or Tezos or others. You can almost think about each of these blockchains as a own mini economic system that has its own economic governance implications, and so I think that's a very interesting area. But today, there are lots of challenges around governing these projects, and unsavory activity, and crypto libertarian implications. So, I think those are some things that we think about that need to be solved over time
as potential challenges or negative impacts.
Yeah, I think globally, it has the potential to be a huge positive and a new way of people transacting and coordinating work and effort to build new things that aren't necessarily that cannot necessarily be censored by their existing institutions or governments. So I think it has the possibility to be a huge benefit for communities and countries in the globe. But yeah, there's obviously challenges too.
Well, there are a lot of challenges and some problems, but it seems like there's also an enormous amount of promise and opportunity. And thank everybody here for your participation today. It's been extremely interesting discussing these points with you, and thanks again.
Thanks.